Set a 20 pip stop and aim for 40 pips. This common retail trading advice sounds responsible, but under actual market pressure, the strategy violently shatters. Relying on a fixed, static number for your stop loss is a mathematical trap. It assumes the market has a steady, constant heartbeat. In boxing, fighters who can't take a hit are said to have a glass chin. In Forex trading, static stop losses act as that vulnerable point. These are rigid boundaries incapable of bending, meaning a minor burst of momentum knocks the trader out of the market. Applying a static rule to a chaotic, dynamic environment creates a structural mismatch. Over thousands of trades, that inconsistency guarantees an account will bleed dry. The daily ranges of currency pairs are worlds apart. A quiet European session on the euro against the US dollar might only see 70 pips of total movement. Compare that to the British pound against the Japanese yen, which regularly whips through 200 pips in a single afternoon. Using a 20 pip stop for both is like wearing a light jacket in both a spring breeze and a hurricane. These two charts show the difference. Both represent the same upward trend, but notice the erratic spikes in the second chart. This is market noise, intraday price fluctuations that bounce wildly without signaling a trend reversal. Failing to measure this noise creates a specific frustration for intermediate traders, getting caught right but out. You predict the direction perfectly, but you still lose the trade. A minor liquidity gap temporarily drops the price past your tight fixed stop. Your position is closed at a loss just minutes before the market rockets straight to your original profit target. Getting stopped out in this scenario is a mathematical failure to account for the noise floor of that specific market environment. Solving the fixed stop problem requires a way to measure the current chaos of the chart. For this, we use J. Wells Wilder's Average True Range, or ATR. ATR does not predict whether the market is going up or down. Instead, it calculates the noise floor by defining the size of the average price swing over a specific time period. Once you know the baseline width of the noise, you apply an ATR multiplier. This creates a customizable mathematical buffer around your entry point. Different strategies require different boundaries. A 1.5x multiplier provides a tight leash for aggressive scalping. A 2.0 to 2.5x multiplier is the sweet spot for clearing daily noise. And a 3.0x multiplier gives swing traders enough clearance to survive heavy pullbacks. By multiplying the ATR, the stop loss sits mathematically outside the random daily chop. The trade finally has the room required to breathe. This is where many traders stumble. They use the ATR multiplier to widen their stop loss, but keep their lot size the same. This effectively doubles or triples their financial risk on a single trade. To maintain consistency, we use the volatility adjusted position sizing formula. You divide your target dollar risk by the total distance of your stop, multiplied by the pip value. Professional risk management requires that your total dollar risk remains a fixed constant, regardless of how many pips your stop covers. As market volatility expands and your stop gets wider, your lot size shrinks to compensate. This balance ensures your dollar exposure remains identical, regardless of how far the price swings. Let's watch this dynamic play out. With a $10,000 account, your 1% risk limit is $100. The current ATR is 40 pips. With a 2x multiplier, the required stop doubles to 80 pips. Dividing $100 by 80 pips gives a maximum position of 0.12 lots. Now, a sudden volatility shock hits the market. The ATR instantly doubles to 80 pips. The required stop distance stretches to 160 pips. To compensate, the formula cuts the position size in half, dropping it to 0.06 lots. Despite the market chaos and a stop that is now twice as wide, the absolute maximum financial loss remains locked at exactly $100. Trusting the formula allows the data to signal when to stay out of a trade. This is known as risk-reward compression. If your ATR-based stop requires 100 pips of clearance to survive the noise, but the next profit target is only 50 pips away, the math has identified a trap. The risk heavily outweighs the reward, providing a clear instruction to stay out. True anti-fragile risk management uses these measurements to identify when a setup is mathematically illogical. In a live session, running these manual calculations is too slow. Execution delays often lead to missed entries or errors. Professionals use sizing calculators overlaid directly onto the price chart. The software reads the current ATR, applies the multiplier, and instantly adjusts the lot size. Automating the calculation replaces the guesswork of manual entry with a system built to absorb inevitable market shocks. Download the FXNX Volatility Adjusted Position Sizing Calculator today. Use the math of the market to stay in the game long enough for your edge to play out.